Hello everyone. I hope you're having a good weekend. In this video, we are going to review a trade I took on Friday. Plus, we are also going to deep dive into some of our tools, especially the ones uh, involving your power of three. And I'll be giving you a more nuanced approach when it comes to use these tools. So before we go into the trade review, let's start by our power of three. When it comes to power of three, you have two tools. One is your daily range probability dashboard, and second is your manipulation probability dashboard. Now, if you open these tools, then you have some numbers on your chart. You have a daily candle schematic on your chart, and you also have a dashboard. Now, the dashboard basically quantifies the size of your manipulations and distributions and shows you the probable range of a wick in a daily candle and the body in a daily candle or the distribution in a daily candle. Now, as you can see, starting from the Asian Open, if you just focus on the daily power of three candle schematic, you are going to be confused because the way daily candle develops on any given day, sometimes you see a wick to a downside, then you see the wick to the upside, distribution down, distribution back up. This is not a correct way of using it. The correct way of using your daily power of three tools is to focus on the numbers instead of the candle schematic itself. And it is even better. And I recommend you that you remember these numbers by heart so that you don't be confused by the schematics that the daily candle is showing you on any given day. For example, if you click on your manipulation tool and display the dashboard and you switch to 15-minute time frame to gather enough data, what this dashboard is telling you? This dashboard is telling you that the following are the probabilities for the size of the wick or the manipulation of your daily candle. It shows me that from 0.00% to 0.3%, there is a 50% chance, or actually more than 50% chance, that your daily candle wicks, no matter if it is a bullish day or it's a bearish day, the size of the wick is going to follow under these thresholds. Now, what do I mean by that? Let's say if you go into Friday, let's have a look at the example of Friday. On Friday, around 6 a.m., 7 a.m., the time when we enter into market, as you can see, if you just focus on the schematic of your daily candle or daily power of three, you can see it has a small wick to the upside and a big distribution to the downside. And if you just focus on the schematic and ignore the numbers, you are completely underutilizing this tool, because this tool is to quantify the price ranges, and these visuals, these daily candle visuals, are just to help you out, right? Now, if you look at the numbers, as you can see from the daily open to the upside, if you measure the wick is just 0.12%. And if you look at the body, then the body is just 0.3%, which falls perfectly under your threshold for your daily candle manipulation. What does it mean? It means that although this distribution down seems like a bearish candle information, a bearish daily candle information, but in actuality, it can be a wick, and the actual distribution is yet to come to the upside, right? So to recap, when it comes to using your daily power of three tools, you should focus less on visual schematics and more on the numbers. You should allow for the historical occurrences in terms of ranges for your candle wicks if you're bullish or bearish, right? Now, as far as your daily bias indicator is concerned, your daily bias indicator simply quantifies your quarterly profiles, which are AMDX and XAMD. Is simply plot your two 12-hour candles on your charts and it tracks if the second 12-hour candle breaks above the range or breaks below the range. If it breaks above the range, there's 60% chance it is going to continue up higher, AMDX. If it breaks below the range first, then there's a 60% chance that is going to continue lower, right? And once you combine that probability of continuation with your power of 3, then you have a complete directional framework. And once you have a one sided framework, you have a breakout to the upside. The power of 3 is also indicating the upside, plus the size of the manipulation falls under the thresholds of high likely thresholds of your daily manipulation and daily distribution. Then you can only start looking for your models. All right, let's go into the trade I took on Friday. Now, this trade was not based on this particular mechanical framework. It was a bit discretionary trade, and it turned out to be such a banger trade. And I was not expecting it to become that much of a banger trade because I take my profits 2 to 1, 3 to 1, 4 to 1, but the conditions were aligned in a way that I held and I anticipated the expansions up, and I'll show you in a while why I did that. So if we go back into the price action of Friday, as you can see, we were trading inside this 12-hour range. We had no breakout, neither to the upside nor to the downside. And if you look at the power of 3, if you look at the schematic of power of 3, it was indicating a downside. But like I told you before, you ignore the schematic and focus on the numbers. Now, if you measure the size of the upside wick and the distribution of the body, the downside, both of them fall under the thresholds of manipulation. Because as you can see, uh, let's measure it right here. If I put this measuring tool and start measuring the upward amplitude and downward amplitude in percentage, then you can see the upward amplitude is 0.12 and the downward amplitude is also uh, around 0.3%. Now, both of these amplitudes fall under the high probabilistic range of manipulation, which means that there is a 50-50% chance that is upside movement is going to be a manipulation or the downside movement is going to be a manipulation, although the schematic right now indicates that this is a bearish candle in the making. But like I told you, the schematic is to just help you see how the range is developing, but you should focus more on the numbers that it is showing you. And if you know your numbers, to remember those numbers by heart, you can allow for the manipulation, even though if it seems like a distribution, right? Now, we have been distributing for past 3 days, as you can see. Then yesterday we had a daily cycle magnetosequential SMT in the PM session, which gave me an idea that, okay, we are going to go back inside the 50% of the range and we are going to clear these intraday highs that we created during PM session. Then if you move to lower time frames and look at the consolidations, as you can see, the market maker was consolidating ever since we had created this sequential SMT. Yesterday, the market maker was just consolidating the price and the price was going nowhere, which gave me a fair idea that we are going to break out of this consolidation and probably take previous day's highs. As you can see, on about 7:30 a.m., we were breaking out of this microcycle consolidation, and we also had another microcycle consolidation to the upside, which gave confirmation to our narrative for bullish prices, providing a potential for a market maker buy model. And as you can see, once we broken out above this consolidation, we went back inside consolidation and we created a sequential SMT. You had your O1 model, which is your higher time frame and lower time frame sequential SMT, session cycle and microcycle. Plus, you also had a session cycle magnetosequential SMT, which is a model in itself. This is where I entered a change in state of delivery. And since we were consolidating so hard uh, from yesterday, I did not take profits because what we do after we consolidate, we expand, right? Consolidation, expansion. What we don't do after consolidation, we don't reverse and we don't retrace. So once we started breaking out of consolidations, I automatically anticipated that we are going to expand higher. As you can see, I held this trade every time the price broken above the consolidation. I took some partials here in case we reverse and go for the consolidation lows, but the price didn't, and it's just broken the consolidation after consolidation after consolidation and this expanded. And once the news came out, we expanded massively up higher, breaking out from your 12-hour candle range, giving us a bullish bias for the day. Plus, our power of 3 was also turned bullish, giving us a further confirmation of our bias. And once we reach the highest probable threshold of a distribution on any given day, I got out, and this was my trade for the Friday. So, the key takeaway from this whole lecture is that you should focus more on the numbers instead of the schematics, because schematics can be misleading because they are dynamic and they change throughout the day. Instead, you should focus on the numbers. And if you are looking for manipulation, then you should allow for enough range, regardless of the schematic and how it is looking right now. We should allow for a healthy manipulation range as per your manipulation probability dashboard. Similarly, for a distribution, you should take profits, or if you are holding your trade, you should hold until you reach the high probabilistic distribution thresholds as per your daily distribution dashboard. If you have any questions, you can ask me in Oracle Chat and I'll see you soon.